Good ECB, everybody. ECB day. The headline of today is Facebook has been defriended. Okay, that's the headline. So perhaps we're going to get the interest rate decision if any of you guys have a team on the ECB. And also you look at the NASDAQ, we had a very strong day, no confirmation on it. Could it eke out one more shot up? Sure, anything can happen, but definitely we have some problems on the day from yesterday and we're still higher on the week. So a couple of days left here, we'll see what happens. Right now, Euro down 17 into the decision. You have a decision, Steve? I'd also like to welcome our viewers from investing.com. I'd like to invite you to find a great broker that suits your trading personality and your trading needs at Forest Park FX. You can click it right on our site, send an email to Trent, Justin, and I'd also like to invite you to become a subscriber and part of our trading family so you could get this type of input every day, every night, be part of our private chat room, which is active pretty close to 20 hours a day, so you'll never trade alone. Okay, so looking at what's happening, the USD SEC really from 78.6 back, I talked about it, it's been sick. So maybe we're going to have to change it from USD SEK to USD SIK. USD stick, bouncing a little bit. Dollar's a tough call right here. Like the sale here, we'll see what happens. I was a little surprised yesterday that the yen didn't participate with risk on. Now it looks like we have a two driver here. You see this? One, maybe it's a three. So I'd be very, very careful about shorting the yen down here. We're getting all kinds of non-confirmations in the end, just in case there's another pop and it continues in stock indexes. But someone once told me, and is my voice okay besides to Martin? Sometimes you have to log in and out.
I can hear you fine, Dale. Yeah, I can
okay.
hear you just fine, mate. Good morning.
Okay, guys. This, I think, is very apropos with what's happening in the markets right now. Someone once told me that markets top with violence and bottom in silence. Well, we're starting to get some of this violent action. You have a 2 in the S&P. You know, it did confirm. Are we going to peak from here, get one more shot up? We're not that far away from all-time highs. So we'll see if the bulls could put it together. But I think that with what's happened to Facebook, what happened to Netflix, I believe we have Apple next Tuesday. Google came in okay. So far there's a couple of teeth left in the fangs. We'll see what happens with Apple. What else? Netflix, that's Facebook, Apple, Netflix, and Google. That's the fangs, right, guys? So anyway, FANG may need dentures by the time this reporting season is over. So specs, I think, can sell rips, and I think there could still be a pretty good correction. The Russell had a little bit of a recovery yesterday. I'm going to be interested to see if the Russell can recoup anymore with what's happening in NASDAQ today. You can see, you know, probably are a lot of stops about this high, but it looks like if we take out 166, we could really accelerate to the downside, at least maybe back to this 160 level, previous double top. You call this a boring week? Yeah, you know what, in currencies, it is pretty boring. You know, you have that one rally to sell in the dollar index up around 80 was a decent scalp, but I don't see that much to do right now currency wise. The euro's really been You know, I keep looking for the euro to come out of the hole and give us that one more rally towards 118 to 120. Maybe today's the day, but it's still not confirming. They keep trying to sell it off, and the daily, it looks like it could go either way. If we flush it here, that could also be a catalyst for a correction, as people would worry about the dollar making new highs up towards 97 if we could flush the euro here. But I thought that we'd at least get to here, and you know, a lot of the whole world now is looking at, can we get a head and shoulders, which means more strength, maybe back to 19.5 or so. So I think this is a pretty critical day for euro, but I could understand your frustration because, you know, we've been ranging for a while in the euro. Okay, see, so close it back over 1750. You could almost make like a little neckline there at 1750, maybe right around here. And if we could break out through 1750, that'd be 117. That could take you to about 1920 would be the count. But first resistance is going to be this line, which it's respected for a long time, even came back and tagged it. And that's coming in up here just a shade over 118. I believe that we're getting some type of rally again in the yuan today. So I still think it's in a topping mode. Not sure if I have it on. Yeah, here we are. Yeah, a little. Okay, another update here. Maybe there's another shot up in the yuan and the correction hasn't begun. I thought eventually we're going to get 360, but maybe we get one more shot up. I wouldn't chase it here. I'd almost rather be stalking it up here at new highs. So really, this is the dog. No, the tail that wags the dog around. So keep an eye on USD yuan. That's a pretty important risk on, risk off factor right now. And if it makes a new high, bodes pretty well for the dollar and other things going with it. So that's pretty much it that I have today. It's going to be very interesting. I know you guys think I'm crazy, but a lot of important things can happen around eclipses, and we have one tomorrow, 1 to 3 days either side of it. So definitely the markets, at least equities, have been revving up. Yields still look like they want to move higher. Maybe that's going to bother the market too if we get the yields heading up towards 3%. We had that. Down here. Here we are. So there's nothing bearish about this up here. You know, we're at major resistance at 298. So we'll see what happens here. Oh, Joseph said that the eclipse has nothing to do with why they think I'm mentally unbalanced.
Don't worry. Everybody read it.
Oh, everyone's ready? Oh, that's right. Yeah. Yeah, I don't even have to repeat it. Okay, Joe, well, you know, I'm ready to lie down on the couch. Can you please help me? I'm on my lithium. So I don't know, either we're going to get a failing rally here or, you know, this is something that Steve pointed out with a rising wedge in the 10-year note. This is a yield chart. So definitely it's broken that wedge line. And wedges usually retrace 100%. So if the wedge line was from here, that means a retest of it. I still think there's a chance of a failing rally only because I think that they might respond to risk off. But either way, a failing rally or up here, if what I think could happen in risk happens, the bonds may end up being a decent buy. So with the yuan being up, Steve was right to be skeptical of the metals. They're starting to look like it's a pretty weak rally. They couldn't even get back to the breakdown at 1240, almost got to it.
Yeah, gold and silver still looks sick.
Yeah. So yeah, you know, everything's spinning around the linchpin, and the linchpin is the dollar. So it's going to be very important, this action in the dollar. We keep trying to break it down and it keeps holding. And if it can't break down, I think it's going to be part of the reason it's going to be risk off. So that's my view coming into today. We have a great guest. Okay, David Brady is going to be with us at Global Pro Trader. And, you know, David was interviewed, I don't know, about 4 or 5 months ago, and his interview continues to be retweeted by people that have, you know, once it's a video, people could watch something that they missed or come across that happened months ago. But one of the most retweeted interviews since I've been doing interviews here at ForexAnalytix. So you want to stick around for David Brady. He has kind of a you know, thinks that there's going to be a major crisis coming. You know, the art of it is the when. So it'll be interesting to see, since he, you know, is a long-term bull in the metals, and he thought we could make new highs in the market by the summer, and in some of the indexes we are. And also is a believer that, you know, the move towards growth is going to be in China. I happen to think that there's going to be, that might be kind of ground zero for the problems that we might be facing because of what China's done with debt. So, you know, one thing that people don't really take into consideration is our Fed's been around for over 100 years. And even just in my trading career, I've seen them stay too tight too long. We've all witnessed them staying too easy for too long, and they're a veteran central bank. So the PBOC, you know, maybe has a decade or two under its belt. That's it. So central banks make mistakes all the time, and if experience is important to learn from your mistakes, it's going to be very interesting to watch the machinations of the PBOC, how they handle the debt problem in China, especially during what looks to be an escalating trade war. We may have made nice with Europe, but it doesn't look like things are changing with China. And I think the reason is Peter Navarro and also John Bolton. So let's have a great day. I guess maybe there'll be some action on the press conference. Does Draghi do a press conference today, team?
Absolutely.
Yes, in just over 15 minutes.
It's all about the press conference, actually, because, you know, it was 100% certain that there wouldn't be any changes having to do with interest rates. I mean, they've told us that, you know, they're not going to be doing any changes until the upcoming summer, so for the next roughly 12 months. So it's all about hearing, and Stelio, this is
they actually, I'm gonna. They actually said there's not going to be any change through summer of 2019. So we're going to the end. So basically, third quarter.
Yeah, although there was a little bit of a confusion with that, because I don't know if you've seen it. The English version was that, and then they gave out the translated versions, and some of the translations were saying up to the summer of 2019. No. Some of the versions were leading for, you know, at least until the summer is over. Then they had to clarify that the English version is the one that we should pay attention to. But in general, I've said it before, assuming, and you know, this is of course an assumption, assuming that globally central banks won't have to reverse course because, let's say, some kind of a big event happens, like the economy going into recession or whatever. So assuming that, I personally, I would take the under having to do with when the ECB is going to move. So, you know, I personally think that if this expectations for the first rate hike and not taking place for the next 12 months has to change, and we don't have a global recession or whatever, I would assume that any change would be to bring it closer in time. A big
change, Steve, would be, wouldn't a big change be, when does Draghi's term end, and isn't he leaving? That would be a big change.
Yeah, although theoretically speaking, it's a matter of consensus what they've decided, theoretically speaking, from what they're telling us. So theoretically speaking, even Draghi changing and being replaced even by the most hawkish, let's say, member of the board, theoretically speaking, that should have no effect to that. But, that's just in theory, because if there is consensus, that means that no matter who takes his place, why would that,
because like Bernanke and Yellen were considered heroic for saving the U.S. economy, and
yes,
heroic like you are, but Draghi also, he was a hero. He took the euro down from 140 to 103. I'll do whatever it takes. He's got that mystique behind him. So whoever comes behind him will not have the same type of star power.
Yeah. Just to point out that Draghi's term ends in the end of October 19. So if they're going to move, they will have moved before that. But anyway,
the end of October this year.
Next year.
Okay.
So it's not something that we should worry about in the short term.
That's way too far for me to think ahead.
Plus, the guy they're talking about the end of, they're talking about summer next year. It's 12 months away. A lot can happen in 12 months. So it's a good guidance for now. But as the months go by, we're going to get much more clarity, I think.
Personally, I give it 50% chance, but that by then they will have to start considering what they have to do to help the economy next, instead of considering when they're going to hike.
So, Steve, we were showing Facebook yesterday.
Yeah,
and Facebook, was had a big throwover over that wedge, and
over that large wedge.
Defriended. It was defriended or unliked yesterday. I'm wondering if it's going to be back inside that wedge formation. I think it's coming in about 40 lower.
We have to see where it's going to open. Currently, it's almost 20%. I mean, we have indications that it's going to open roughly 20% lower, which could barely.
Should I cover my puts on the open?
I think it's not that a bad idea.
Oh, I just woke up. It was a dream.
But if you had, that would be lovely.
Yeah. Someone did.
Oh,
probably Zuckerberg.
For sure. I mean, just to give you I hope there isn't anybody that doubts that, of course, they knew in advance, right? I mean, let's simply put, not only we got earnings results, etc., whatever we got, it's that they also guided lower for the time to come, which this is something that you don't find out at the last moment, right? I mean, they knew in advance, which means when you be selling your stock up there, if you knew that, earnings would miss and you would have to actually guide lower, definitely you would. So
they're not supposed to be allowed to do that, but in a perfect world.
Yes, exactly. In a perfect world, probably Stelio, in the same kind of world that Draghi and Yellen are heroes and save the economy. In
the same world that Draghi's son used to be a bond trader, might still be a bond trader at JP Morgan trading European government bonds. I remember that years ago.
Yeah.
So
Did you try and sit next to him then?
No, I wasn't at JP. I was at another bank.
Yeah, you're at Merrill.
Yeah.
Right. Yeah. Okay.
But that would have been definitely, a good spot to have next to him. I mean.
So, before, actually, you were going to talk about Facebook, Steve.
Yeah, Steve, why don't you show the chart we were looking at yesterday, and
absolutely.
Maybe we could guesstimate. I really think it's the event of the day. I'm going to be interesting to see if they try and do the same thing they did with Netflix. Remember what they did? Netflix was 50 lower and came back to recover most of that loss. Yeah, I'd say we're going to be back inside that wedge, Steve.
Roughly, we're going to be actually roughly at the wedge's support. So from an overthrow, we're going to find ourselves struggling with the 200 DMA. As you see, this is a huge mover.
Isn't that something, from an overthrow to a breakdown in 24 hours? I've never
and
seen that before. I've never seen that before.
And
I've
keep
seen
in mind,
a lot.
Keep in mind, we were in an ascending wedge, overthrowing a bigger ascending wedge, which actually came to exist after overthrowing like a very long-term ascending, very bullish ascending channel. So any way you look at it, I mean, we've seen this kind of price action multiple times in the past, right? Something going from bullish to very bullish to parabolic, and then something happens and it snaps, simply because these kind of rates of appreciation are unsustainable. Any way you look at it, I mean, mathematically speaking, simply unsustainable. It's a matter of what is going to break the camel's back, right? So that's always the case. Now, you spoke about Netflix. This is the situation with Netflix. We had an equivalent overthrow. We had a triangle, and then boom, broke down. We retraced back. We retested the triangle, and we're tripping lower from there. So that's a second.
So all we have is, and we had Alphabet.
Which held. It's the only one that held.
So there's only one left, right? Apple is the last one.
We have Nvidia as well, but look at Nvidia. I mean, Nvidia is already, for some time now showing signs of weakness, right?
The semis as a group haven't made a high since I think the beginning of the year.
I think that the only thing that's currently holding it from breaking is the fact that Bitcoin has actually mounted a decent rally during the past several days, and that for sure, will be helping Nvidia stay afloat. But don't have any. I don't have any doubt that whenever something happens here as well, and don't forget that Nvidia reports in the middle of August, so perhaps that's going to be something that will happen then in earnings.
But Nvidia's not the N in FANG, is it? Netflix is.
Yeah, correct.
Okay,
but,
so we've had Facebook.
Also like
the only FANG
Netflix,
stock that hasn't reported is Apple, right?
Apple, which reports at the 31st of July, which is in the upcoming
right.
It's in the upcoming Tuesday, and this is the situation with Apple. We have another wedge here, right? There it is. So why not? We might see this wedge producing some kind of a surprise as well. So this
why
is
don't we rename the company FANG Analytics? Where the action is.
So here is Apple. So if actually we get a rejection from this wedge, we might be looking for the whole FANG momentum that was keeping stocks up, like
Here's a big question: FANG caves, where do they rotate to? Value stocks? Where's the rotation?
That's a good question. And wait a second. What is the definition of value stocks? By the way, we're going to come back to FX, people. I mean, because we have the presser starting in 5 minutes. Stelios is going to help us cover it. Until then, let me make a very brief stop. Until then, Euro USD still holding this triangle. Cable still has broken above 133. USD yen trying to hold this ascending trend line here. So the vast majority. I mean, the only thing that has been moving really decently today is the Aussie, is the Kiwi, somewhat it's the CAD, and having to do with the DXY, because we know that a big component of the DXY is the Euro USD. Not coincidentally, as you see, we're seeing a little bit of a bullish reaction exactly right on the triangle that we were monitoring. So it's very, very simple. If we do see the pressure pushing euro lower, there's no question about it. The DXY is going to rebound from this triangle support, and perhaps this is going to be a rebound that's going to lead to a break higher and another push to the upside, targeting as a first target the 96.50 level. We've indicated that is going to be the next area of resistance. Now, if for some reason we see the euro strengthening, obviously we're going to have a breakdown from this triangle, and I think that inevitably the DXY is going to be coming down to retest that 92, this multiple confluence of supports here, which comes at around 92.70. So, it's a binary event. We have a binary possible outcome from a technical analysis in the DXY and in the euro. So we're going to find out very soon. Until then, all bets are off, because simply making an assumption. I mean, I always like to take a position ahead of these events only if there is the market underestimates or overestimates a lot the chances of something happening, in an extreme. In this case, I don't think we have something like that. So I think that, it's pure gambling, trying to guess in advance what Draghi is going to say, how he's going to answer the questions. Because don't forget that Draghi is going to have to go through some questions, like we had the statements from Trump that was talking about the ECB manipulating the euro, obviously doing that against the interests of the US. So I'm pretty sure that there's going to be some kind of a question to Draghi about that. And, he's going to get a lot of opportunities taking a position. Obviously, they're going to ask him again about their conviction in keeping rates at negative until next summer. So, any change in the tone, in the language, or in expectations, or even any change in conviction about the guidance they've already given us, will be interpreted as bullish signs for the euro. So let me be clear here. I consider the likelihood of a dovish surprise very, very low, right? That doesn't mean that the market won't move lower, because, for example, if we get something neutral from the ECB, the market might just take advantage of that and keep moving lower, because that's what it wanted to do, and it just stalled because nobody wanted to take the risk ahead of the ECB. But I consider dovish news coming out of today's presser, which will help the euro tumble lower, even faster, a very low probability. I think that if we have some kind of a surprise, some kind of an answer that's unexpected, it's probably going to be to the hawkish side. So that's my personal point. Now, having said that, until the pressure begins, having to do with value stocks. At the current valuations that we have, Dale, what is exactly considered a value stock? I mean, I know that the definition doesn't have to do with that, but when something is called a value stock, I would want to see it having some value, having to do with future expectations, with valuations being what they are, even for defensive stocks. What would be considered a value proposition here? I think there is no value proposition in the market currently. The market, of course, can keep moving higher for a period of time, but as we've said multiple times, the easy part of the move higher, in my opinion, the vast majority of the move higher has already happened. So, people that are buying here to hold are doing something extremely dangerous, are collecting like pennies in front of the upcoming train on the train tracks. I mean, it's, we're much closer to a top than we are to a low. That's the only certain thing, considering that we had a low 9 years ago, and since then we've been in a brutal uptrend, which isn't even based on true strength of the global economy or the US economy or whatever. Speaking of that, I need to remind that today we have, of course, GDP coming out as well. This is going to be probably a high print, might be in, the expectations are for 4.1%, Stelio. Am I right on that?
Yes, but is it today? Are you sure?
Oh, it's tomorrow. Sorry. Yeah, you're right. It's tomorrow. Yeah, my mistake. It's tomorrow. Yeah. Tomorrow. Yeah, tomorrow we have GDP. So that's also going to play a role. So that's another reason why the market, if we get the Draghi more or less sticking to the expected things, for him to say, I think this is another reason why the markets might end up not moving much, because the market is going to immediately turn into waiting and expecting what's going to happen with the GDP print. Of course, the expectations are high. We have a 4.1% expectation. This is not going to be the first time we're going to have a 4 handle in a quarterly GDP. We had multiple 4. I think we even had once in 2014, if I remember right. We even had a quarter that we had a 5.0 percent quarter-on-quarter GDP growth, but almost always, and if you see, if you've seen, we have a trend. We tend to have stronger quarterly prints either in the second or third or in both those quarters, and usually we end up having weaker prints in fourth and especially first quarters. So I wouldn't be really too much surprised even if we saw a 4.5% in a second quarter. That's not going to be the first time it has happened since the end of the previous recession. The question is what happens next? I mean, it has to be followed by another strong quarter, and we have to have a good fourth quarter as well. Personally, I'm not that optimistic. I don't think that the US economy is going to get unstuck from the average of like roughly 2.5% during the year. Perhaps it's going to climb a little bit higher, like a little bit closer to 3%, which, you know, isn't actually changing much from what we've expected to see during the past several years. Now, Stelio, Draghi should be starting shortly, right?
Yeah, I think some of the text is already out, and not much is happening. I think, as always, he's just saying the same thing. Interest rates to remain at the present levels at least through the summer of 2019. You know, uncertainties in global trade environment. He's just saying the same things that we know.
While uncertainties notably related to the global trade environment remain prominent, the euro area economy is proceeding along a solid and broad-based growth path, which more or less is an optimistic message here.
Yeah, it's going to be all about the Q&A again, once again. So
some weak data I see here from the US. Wholesale inventories for June, 0.0, while we had expected 0.3.
Small miss in durable
significant monetary policy stimulus still needed. Okay.
To be fair, he said this last time as well, so it's not something.
I know. That's why the market isn't reacting, but because it's exactly what he said the previous time. The previous time it was more or less a surprise. I mean, let's be honest. The previous time, the message relayed by Draghi was more dovish than the market expected. It was more dovish than I expected, and now he seems to be reiterating the same things. So far, literally zero reaction from the market. Zero. I mean, euro is stuck between 117 and 117.5. I doubt that we're going to see some kind of a reaction before the Q&A starts, because most probably, you know, in the preset text, he's going to be repeating the same things. But let's see if some questions will lead him to give us something more than he has so far. Personally, as I said, I doubt it. I think that if there is some kind of a surprise, it's going to be hawkish, but I doubt that we're going to have any surprises, to be honest. I mean, we're still far away from what they have indicated that might lead to a turn in monetary policy. Speaking of which, Stelio, they've reduced QE to half, not now, I mean, in the previous meeting, until December, where QE is supposed to end. Am I correct on that? They reduced it from 30 billion to 15 billion per month.
Until the end of the year, yes.
And until the end of the year, yeah, exactly. So they're finishing up QE, at the end of the year, and then they're expected to hold for at least 6 to 7, 8, 9 months before they hike rates. Personally, as I said, if we haven't gone to some kind of a global recession, I think it might change. It might come, closer to what people expect.
With the current setup of DSI and overwhelming bullishness for the dollar, when you think that the possibility of stop hunts above the market in the euro could be a pretty good possibility over 1750 and then 1780. And the grand prize goes back to the last ECB meeting up around 1860. That
Yeah,
they're
1850,
all the dollar,
1850.
all the euro bears have their stops above those levels.
1850 is definitely a significant level.
Yeah.
But having to do with the DSI, keep in mind that the FX, right? Euro DSI is at 42, which is a very neutral reading, more or
is
less.
it? Oh, so, but the dollar was at what, 90, right?
The dollar, at some point actually hit a little bit higher than 90. It's currently at 79, having to do with yesterday's reading.
That's kind of weird.
It's not extreme. Definitely, it's not extreme.
You know, I mean, yeah, it's not. It's kind of weird. It's that much bullishness in the dollar and neutral sentiment in euro.
Yeah, neutral sentiment indeed. 42 is very, very close to neutral, actually. Yes.
Yeah.
So the market is definitely not overly bearish. The euro, not by any chance.
Okay.
And since we had a little bit of a reversion to the mean during the past few days, I mean, even the gold and silver's DSI jumped somewhat to 18. Platinum jumped to 28, palladium to 44. So palladium's DSI recovered very fast. Copper recovered to 24. So so far what we've been seeing might end up being like a little period of working out, temporarily oversold and overbought conditions before actually, resuming. So I don't think that sentiment is going to be a headwind or a tailwind for anything at the moment here.
Yeah, I just someone put a gun to my head, I'd buy it, looking for buy stops to be taken out to the upside.
Draghi sees inflation around current levels for rest of the year. Underlying inflation remains generally muted. Domestic cost pressures are strengthening. Okay, so neutral to slightly.
Yeah, he also said something a little bit earlier, which I now missed. Hold on. Which was again quite constructive. So latest data have stabilized, and they point to ongoing growth. So he's not being dovish so far.
No, he's not being dovish so far. Yes, I mean he's neutral to somewhat.
Draghi's a 45 on the DSI today.
No, I would actually say he's probably a 55 to 58.
Okay, I knew you'd correct me. Indeed, Steve.
So far it's proving to be an extremely boring. It's proving to be a non-event, actually, right? I mean, look at the markets. Yesterday it was the first time in months that I had to, for basic technical analysis, that I had to write no change to many pairs. I mean, literally, we got some movement at the end of the day, but that wasn't enough to change the technical picture in a lot of the tickers we're currently monitoring. And this seems to be the case so far today. Let's see if we get something more out of the Q&A, or let's see if tomorrow's GDP print can actually bring back some volatility. Obviously, the fact that we are exactly in the middle of the summer doesn't help with that. Let's see if earnings will also do the trick. I mean, so far we've seen some disappointing numbers where it mattered. So perhaps earnings are also going to give something to the market to think about. But yeah, so far nothing. Stelio, anything more from Draghi?
Not that I have seen, I'm afraid. So we wait.
Uncertainty around inflation outlook is receding. That's also constructive, actually. Underlying inflation to pick up toward the end of the year. Underlying inflation to rise gradually in the medium term.
But that's actually in line with their forecast as well, right? So
yeah.
So I mean, not to take away from the fact that he's not dovish, he's not dovish, but he's not giving us much new information. That's the thing, and you can see euro-dollar is up 10 pips, I think, since the press started.
Implementation of structural reforms must be stepped up. Okay, that's a regulatory message mostly, so it doesn't really affect the currency. Yeah, so far more or less nothing. Let's see if he gets any interesting questions that he has. I'm really curious how he's going to respond to Trump's accusations about currency manipulation. I'm really curious.
Actually, having said that, we should mention yesterday's meeting between Trump and Juncker.
Juncker, that's a good point, Stelio. So since we're not getting any movement yet, so mention that.
So funnily enough, both sides saw that as a victory for now. So basically, they reached an agreement to not impose any new tariffs for the moment. And so the European side saw this as a big win because, you know, Trump has threatened with tariffs, especially on autos. But on the other hand, Trump said that the Europeans are going to be importing much more LNG and soybeans from the US. So both sides were kind of happy about it. But the main thing,
though, there was no mention about the auto industry. Am I right on that?
Yes. So, and they said they're going to cut trade barriers on other industries apart from autos, which is a big one always. But the main thing is that for now, there are no new tariffs. There's nothing happening. So, at least they're talking. So that's why I think both sides are taking it as a small victory, and they keep going.
You know something? I think it's basic intelligence that, as a country, you don't want to have an ongoing war in several fronts at the same time, right? I mean, the situation with the Chinese has obviously not really de-escalated, so you don't really at the same time want to escalate the situation with Europe. It makes no sense.
True. Although Trump is actually, waging wars on 10 different fronts. But yeah, you're right. You wanna take things slowly, and you want to fight one battle at a time. That's for sure.
Yeah, ideally that's the case. Okay, let's see if we got anything new from Draghi. Euro is really currently the daily candle is a doji, so really completely unmoved on the day so far. Urges governments to raise long-term growth potential. Implementation of structural reform must be stepped in, and urges governments to raise long-term growth potential. Okay, once again.
So that's a very vague statement, right? I mean, yeah,
that's an extremely vague statement because
nice and to be profitable everywhere. How'd you do it?
Yeah, or it's like when they ask candidates for beauty contests, like what would you want, like world peace, children to be happy, and these kind of statements.
He did actually mention the Trump and Juncker meeting. Just now, I'm reading that he said it's a good sign. So
yeah, definitely, it's not a bad one.
Okay.
My God, nothing is moving. It's amazing. Nothing is moving so far. We've already been 15 minutes almost in the pressure. Nothing has moved. I mean, this must be a record range having to do with how small it is, given that
they all want to call it day and go to the beach or something.
So that's how it looks, honestly.
I'll keep an eye on these headlines. If you want to cover any instruments you want to cover, and
I'm going to start going through effects. In all honesty, please keep the euro up as I'm showing everything else, and tell me if it happens and it moves from something, because so far it's like dead.
Never sell a sleeping market.
This
is definitely sleepy.
Yeah, it can't get sleepier than that, actually. The range so far on the day has been, the high was 117.40, and the low has been like 117. So it's roughly a 40 pip range. It's nothing for a pressure. Draghi says we took note of US-EU deal. Okay, yeah, that's what you were saying. Okay, let's see what we have now. Having to do with Nasdaq. Obviously, Nasdaq. Let's go through risk first, and we're going to go through FX. Nasdaq is obviously being affected now by what's happening in Facebook. Yesterday, it pushed higher once again in new all-time highs. Hasn't yet reached this nice confluence of resistances at 75, 60 to 70. Might do so later today, although doubt it's going to be today. Given the fact that Facebook is, is under stress. But still,
we also have Amazon earnings. One of our astute members talked about that we still have Amazon to report. So Fang has two ways.
Amazon reports today, right?
Today, okay.
Yeah.
So that'll be at Amazon and then Apple, and we've got them all.
Yeah. And do you think we might get the same story once again? I mean, look at Amazon here. Amazon has overshot this ascending wedge after overshooting another triangle, after parabolically accelerating through another triangle. Because, if we zoom out, you remember we were talking about it the other day, that this is simply parabolic price action, right? And it seems to be consolidating. Yeah, it's actually hitting all-time highs as we speak.
It's got your green moving average discombobulated.
No. This is not a green moving average. If you
that's your parabolic line. Oh, okay.
Yeah, we drew that together, right?
Steve. Though Amazon, the difference with companies like Facebook is that their profits margins are quite small still, but their business is growing at a ridiculous pace. And I read the other day they account for 49% of all global online purchases. Basically half of all. I mean, that's a ridiculous number. If you had asked me, I would have said 10, 15, 20%. It's actually half of the global online business.
You're very right, Stelio, but as everything, and I'm not saying that Amazon is going to implode. Obviously, Amazon, has already the lion's share in, the online market on several products, and obviously it has a very healthy business model. But this kind of an appreciation can't go on. I mean, it's as simple as that. At some point, it will have to pull back and stabilize at a different level. I mean, we've seen that happening again and again in the past. Just look at it. It's unstoppable for the time being. But
it's an Amazon.
By the way, guys, Draghi said that the euro has appreciated considerably in the last 1.5 years, despite ample stimulus. So the euro dollar is down 15 pips on that. So, little move here and there, nothing.
Nothing. As you understand, Stelio, this statement was indirectly targeting.
Trump.
Yeah, exactly, because it's like answering in advance. I mean, before he even gets asked, at Trump's accusation that the ECB is manipulating the currency to keep it depreciating, or anyhow keep it from appreciating and keep it weak, right? So this is obviously an indirect hint of how he's going to answer when that question comes. So yeah, euro is like 20 pips lower, but so far not much to see here. I think that the catalyst, it's more than obvious that we're not going to get any major breakouts today. So the catalyst might actually come from the GDP tomorrow, because obviously, for example, a very big GDP print from the US can lead the DXY appreciating, and as a result, we might see euro pushing lower once again, pound pushing lower once again, Aussie and Kiwi getting rejected from equivalent levels, because don't forget, Aussie broke, or anyhow almost broke out of the, let me switch to Aussie and then I'm going to come back to Kiwi. So Aussie broke out of this triangle yesterday, but it's already pulling back. As long as it stays below this 75 cents area, that might actually not prove to be a triangle, right? Triangle was one interpretation, or the triangle might be this, or it might not be a triangle at all. It might just be a range between 73.20 and 75. But one thing is for sure, the key resistance here is 75 cents. So as long as the Aussie remains below 75 cents, we have to respect the potential for more downside. And as I said, if tomorrow we get a, a big GDP print out of the US, you know, we might get the Aussies slipping through the 73.20 support, and you know, on its way to the next target, which is going to be at 71 cents, which is the 161.8% extension of the last move higher for the pair. Kiwi yesterday was testing this triangle. It actually closed just above it. We seem to be slipping below it, but you know, once again, the critical level here was the confluence of this horizontal support resistance area and the 50% fib of the last move lower, both of them at 68.70, 0.6870 obviously. So, you know, as long as the pair trades below there, why not? We might see another push lower. We have a nice confluence of supports at 65 cents. So that's what might happen tomorrow if we get a, you know, a strong GDP print. What else? Yeah, USD CAD, by the way, I forgot to mention USD CAD. I'm taking profits today at half of my position USD CAD, simply because it almost made, it actually touched the zone that I was targeting. This is exactly what we were targeting, the 130 zone. It almost touched it today. Today, I'm definitely booking half of my profits at some point before the day is over. So, you know, I would start being a little bit cautious with the USD CAD here, especially ahead of the GDP tomorrow, because that might simply be the case of an ABC pullback, you know, a pullback to retest this horizontal support resistance area. If it slips lower from here, it can even go down to the 50% fib of the move higher, which coincides in a couple of days from now with this broken descending trend line resistance, which this time might act as support. And you know, we might just move higher from there. So I think, you know, I already achieved what I was looking for. I'm gonna at least take some profits because, you know, there is the danger of seeing a rebound tomorrow, because I'm fully aware that currently I was trading this counter trend. At least in the medium term, this is counter trend. So I think that the USD CAD, you know, moved nicely. But this is not the place to be selling it anymore. Now, having to do with gold and silver, we said it. I was very, you know, unconvinced about the rebounds we were seeing, simply because they don't look constructive. I mean, look at the price action in gold, right? We've already have like 2-4. This is the 6th day of more or less a consolidation, because the attempt to move higher has really not produced much. I mean, we haven't managed to close on the daily above like 12.32 when the closing low was at 12.22. So between the closing lows that we had and the closing highs that we had after so many days of an attempt to rebound is just $10 away. So I'm really not convinced that gold is done moving lower. And the same thing applies to silver. I mean, it closed above this descending wedge yesterday, but really I'm not impressed in the way it's rebounding, and I would definitely not be jumping the gun as long as it still trades below 1575. I mean, I wouldn't be doing anything about that. Whoever wrote my analysis yesterday about silver, I was actually explaining how many hurdles it has to pass before it can actually convince me that you know, I should be looking at it with a different in a different way. Until then, I just see a loss of downside momentum at the 161.8% extension. I mean, nothing moves in a straight line, but you know, I would consider it likely that this proves to be, let's say, a channel instead of a descending wedge, and we might have more downside. I mean, the 78.6 of the flash crash low to the high that followed comes at 1480. Then we had the flash crash low at 1390. I mean, why not? It can resume its move lower. From a fundamental perspective and from a macro perspective, I don't agree with its movement lower. I mean, I think that they have value. Both gold and silver have value in the long term, but that doesn't mean that I'm going to go against the technical picture and start buying it blindly, right? So this covers silver and gold. Let's have a look at crude, actually, because we were talking about it in the chat room earlier. I still see a consolidation here in crude. This looks to me like a triangle. If that's the case, I would expect that there is more downside. One more leg lower towards the $66 area looks a high probability scenario to me. So I wouldn't be buying it yet. Okay. I wouldn't be selling it down here because 66 is a very, very strong area of support. So I mean, I had a position short in crude and they did it very well, but I wouldn't be selling it here because where would I place my stop loss? Since I know that my downside target would be limited to $3, right? 66, triple confluence of supports, quite important for the trend. And since since as long as we trade above that, my medium term outlook for crude is bullish. I wouldn't want to be trading it counter trend with such a short, such a close target, right? But as I said, that doesn't mean that it can't move lower. I think that it can move lower at least once again, produce one more leg to the downside. So if I was a short-term trader, I'm not, but if I was, let's go down to a 4-hour chart. I think, you know, it's a nice risk reward proposition to be looking, you know, for an extension from there to here. But, you know, that's not my trading style. I'm just mentioning. Dale, I hear you breathing. Do we have
Yes.
do we have to start the interview? What's the situation?
We can, Dave. It's here if you'd like.
Okay, let me see if we have any questions, and then yes, I'm going to pass it to you. I know that a lot of people want to hear what David has to say. Good morning, Dale. First time on board here. I was wondering if you guys have discussed about that the euro seems to be gainer with EU-US agreement. Is this a tell for the greenback view medium term? Pete, I do think that the dollar will depreciate a lot in the time ahead, but not yet. Okay, for various reasons. If it's your first time here, we've talked several times with Stelios why we think that the dollar is going to be a loser in the long term. And we can discuss that tomorrow as well. NVIDIA is part of the Fandango, says Bob. Good morning, MT4. Was doing something with upgrade. Not sure though. Blake said something weeks ago. Yeah, we're going to start supporting some functions in MetaTrader having to do with ForexAnalytix. So you will be able to see some of the ForexAnalytix stuff on your MetaTrader. That's something that's going to be getting released probably in the beginning of fall, just after the summer. Many more details to come, obviously, on the tariff front between the EU and the US. That's true, mate. If central bankers are doing a proper job, then there shouldn't be huge reactions to any particular rate decisions or even presses. That's a good point, actually. Yes, mate. If I covered the DAX, no, I haven't, but I'm going to have a look at it so then he can start his interview. So DAX, not much to say about the DAX because, and the reason why nothing has really changed about the DAX is because the DAX is still holding, barely, but it is holding this confluence of resistances here at 1270.70 roughly. Why? Because this is the 61.8 of the move lower. It's also the 200 DMA. So let's see what happens from here. If we get it rejected once again, we might see more weakness. If we break above it, that's definitely you know, a step to the right direction for the bulls. Okay, so DAX once again on a critical resistance. Obviously, buying it right on the resistance doesn't make much sense. I'm keeping an eye on this level. It's very, very important. FTSE attempted to break above this bull flag, seems to be slipping back right on top of it. Let's see if it's actually going to move from here, or then we're talking about some other kind of a complex correction. So the rest on the chat room so far, as we've seen, this has been one of the most boring major central bank events that we've had this year. The euro is at its lows, but at its lows doesn't really mean very low. I mean, it's at the lows of the day, and you know, at a day that has a range of just 40, 50 pips. But anyhow, seems to be so far. What you need to know is that so far it seems to be rejecting once again this triangle's resistance, and as long as that's the case, given the fact that we entered this triangle from the upside, you need to respect, and I haven't changed anything in my drawings for several days, you need to respect the potential for one more push lower. And as I said multiple times, tomorrow's GDP, if it's an impressive number, a 4 or even a 5 handle, might be the catalyst for such a move. Thank you, Dale. Enjoy the interview. See you all in the chat room.
Thank you, Stevie. Stelios. David, thank you so much for coming back. The most tweeted, retweeted interview in face history. Looking forward to speaking to you, my trading warrior brother. You have the control of our television set.
Amazing stats. I wasn't aware of that, Dale.
Huh?
Those are some amazing statistics. I wasn't aware of that.
Oh, yeah. I mean, months after people are retweeting your interview. What was it, from about 4 months ago, 3 months ago, buddy?
February, yes.
Okay. So that goes to show you that you can have some views that are more valuable than just what's happening today. And you're excellent at painting a narrative of what your views are, David. So thank you so much for coming back. And people could follow you at Global Pro Trader or go to your website. How about an update on the scenario that you painted in your last interview? Some of the markets have moved quite a bit since then. I'd like to start with, I found very interesting, I follow you on Twitter, David, and one tweet that you made was really thought-provoking. And I think it was during a Powell press conference, or maybe a Humphrey Hawkins day, and he talked about when they were going to end their draining of reserves. And I think he talked about late next year, which you interpreted as that's when the recession will begin. Do you remember that?
I honestly, I don't. I tweet way too much.
It was like you said, this is important. It's like Powell's giving us a signal of when they're going to stop draining. And he was talking about that it should be complete by the end of next year. So
yeah.
Anyway, let's go with what you had planned to talk about. And did you defriend Facebook today?
I've not been on Facebook for the past few months, ever since the privacy issues came to light. Okay. But I'm not surprised. I mean, Jeff Gundlach called this a while back, and as it's been tweeted a lot in the last 24 hours, Mark Zuckerberg has been selling his stock like there's no tomorrow in the past 12 months. And insider trading or insider sales are a clear signal of what's to come. So, yeah. Okay. The bigger issue is the leaders seem to be faltering. If you look at the FANG stocks, Netflix had an awful quarter, and the guidance was more important. The same with Facebook. And the comments out of Facebook seem to suggest that it's going to get worse before it gets better. Now, Google is the shining light, but when you've got 2 out of 3 so far are negative, there's only a few more that need to come out negative. And
yeah, like Apple next week, and then and Amazon. So right now the FANGs only have 2 teeth left.
Only 2 teeth left, and then I would throw in, maybe, if it's not in the FANG, but I'd be watching what Microsoft has to say as well. Okay. But the point is, once the leaders start to fall, if you go back and look at 2007 and 99, once the leaders start to fall, then you should be more concerned about the overall market. But today I want to go back to your Powell comment. He alluded to the fact that they're probably going to end QT early, and Fed's Harker also said the Fed member Harker also said in June, I believe, that they expect to halt their rate hikes in mid-2019. Now, that's more conservative than previously, than has been shared with us by other Fed members, including Powell. So you can see that there's a slight reversal or retreat by the Fed here in terms of what they're doing on the balance sheet and with regard to interest rates. But we'll get into that later. I personally only see them being able to get one more rate hike in September, given what I'm about to talk about.
Okay.
But
And you know they have to go in September because just to show their independence, with President Trump talking about that he's a lower interest rate guy and he really doesn't like it, but he's going to let Powell do what he wants to do.
Exactly. I mean,
right.
If they really wanted to show it, they would raise 50 basis points. But I expect 25 in September. But there's a lot of headwinds they're running into in October, in particular, and we'll get into that momentarily. Okay. But
Looking
I just want to start out, Dale. I've got a lot to get through today, so
go ahead. I won't interrupt you. Go ahead.
No, please do. Please do. It makes it entertaining. But I just wanted to quickly go back to what I said in February, which was that we were going through what I called our Bear Stearns moment at that time. But we were sitting around on February 14th when we did the interview. The opening on the S&P was 2,700. We'd come off 2,530, I believe, was the low. We went back down to 2,550 in April. But since then, as I forecast, we're going back up to all-time highs. I expect the S&P to hit around 3,000. It's not hit an all-time high yet, but we have seen them in the Russell and the Nasdaq. So it's only a matter of time before the S&P follows through, in my opinion. And I say this because this, provides some credibility to what I'm going to say next or over the course of this interview. And I'll just skip through here.
Okay.
As I said back in February, that was the Bear Stearns moment. We're now heading into the Lehman moment. I am now looking for a negatively divergent all-time high in the S&P on the monthly chart, along with several other signals, which I'll get into later. But this will be one of the signals that tell us that a crash in stocks is imminent. Now, you could argue, well, we already have negative divergence. Well, that's not true because we haven't hit a new all-time high yet. But even if we get that, there are other signals that you need to look at. You can't look at any one signal in isolation. You need to have confirming signals with that. When you get multiple signals pointing in the same direction, you have confidence that a stock market crash is about to occur.
So are those the three momentum indicators you're using for confluence of this event?
Yeah, with regard to technicals, these are my favorites. Yes, the RSI and the two MACDs, but there are others that I look at too, and we're going to talk about those shortly. But
we'll also have it on the weekly too, right, David? The weekly
I look at multiple time frames. Yes.
Okay.
The monthly is a lagging indicator because it tags the end of the month. But you may see this ahead of time on the weekly and the daily for sure. And I look at all three. I mean, I even look at hourly sometimes, but you're absolutely correct, Dale. You should look at all of the time frames. My timing for this is ideally October. It's pre-midterms. Now, it could be slightly sooner or later, and based on the recent results from Facebook and Netflix, it could be sooner. But the point is that I believe October is typically the worst month for stocks. And it's pre-midterms, so ideally that's my target, but I'm not tied to a specific month. It can be slightly sooner or slightly later, but that's my forecast, and I'm looking for about a 30% decline. Could be more, could be less, but about a 30% decline. And lastly, the manner of the decline, in my opinion, will be a 1987 style crash, a V-type crash, as I call it. And why? Because stocks are 150% of US GDP today, and they're critical to federal tax receipts. So the Fed and the US government in particular can't tolerate a prolonged stock market downturn. Otherwise, you're going to blow up the US budget deficit. One would say it's already blowing up with the tax cuts, more spending, talk about 1.5 trillion infrastructure spending bill after the elections, and more tax cuts potentially. But if the stock market drops significantly, and it's a prolonged drop, that'll have a significant negative impact to federal tax receipts, which will impair the US government, the US deficit, and will raise concerns about the perception of insolvency of the US, which it all comes back to bonds at the end of the day to service US debt and their ability to issue debt, not their ability to repay it. They can't repay it. They are already technically insolvent, but their ability to issue new debt to replace the old. If the stock market has a prolonged downturn, people are going to question that. And that's why I believe the Fed will respond relatively quickly. But the Powell put is a lot lower than the Yellen's put or the Bernanke put or the Greenspan put. And that's why I say 30 to 40%. So let's get into why I expect a stock market crash.
What are the headwinds in October? I think there is something politically with budgets in the fall before the elections. And just one more thing, I'll bring it up before I forget, David. If you're using the 1987 analog for the type of decline we're going to have, in 87 we peaked in August, broke for about 7 weeks, and then put in a failing rally. Could it be similar this time, that we peak in August as well?
It could be, as I said, it could happen sooner rather than later. And as you know, the results from
I'm
Facebook.
just saying that's how it went down in 87.
Yeah, I'm speaking more to the pattern itself, the fact that it dumped so far, so fast in a matter of days, and then it recovered soon after. As opposed to the 2008 crash, where it meandered lower for a period of time from October 2007 until mid 2008, and then it dumped, like a lead balloon. I think this is going to be a shock drop, and then it's going to rebound on Fed reversal to QE, and global central banks do the same thing. And that's what I mean by 1987. It's not going to be a long, drawn-out crash. It's going to be relatively fast, in my opinion.
Okay.
So why do I expect a stock? And by the way, it's nice to see that since February, a lot of people have jumped on board on this call. I get into that later, but there's a lot of really good names that have come out and said that they more or less say the same thing. The beauty of that is that they come from different angles, and when you have different arguments for the same result, and they're credible arguments, it adds weight to that argument. So we'll talk a little bit more about that today. So quickly, this is, I want to first talk about global liquidity, and I expect that to turn negative in the, towards the end of the year and the start of 2019. Ron Stoifler put some great charts together on gold, but also on stocks. And he's got like 2019 turning negative. Now, why is this important? Well, global liquidity is everything to the stock market. Now, other people will debate or argue with me that the stock market rally since 2009 is driven by fundamentals. I call that hogwash. It's been driven by central bank stimulus. It's pretty obvious. When that punch bowl is removed, the stock market, like any Ponzi scheme, runs into trouble. If you don't have increasing inflows into stock market, they simply stabilize or fall, which would be the worst case scenario. The stock market's going to run into trouble. And according to charts like this from Incrementum and then this from Nordea Bank recently in June, they believe that, according to their indicators, liquidity is already dropping. And that's a major headwind for stocks going into the end of the year. So that's the first aspect of why I think stocks get into trouble in October, certainly Q4. Then we have Lee Adler, who's I think an aficionado on the Fed and their machinations. He's basically said that the Fed is going to cause another headache for stock market in October, because it reaches its maximum drawdown of its balance sheet per month at 50 billion, or put a different way, 600 billion annually, and that the bond market can't absorb this drop in demand, especially when soaring budget deficits are adding 100 billion of new supply every month on top of the 50 billion in less demand. At the same time, you got the ECB, BOJ, SNB tapering their QE. Foreign central banks are buying less US Treasuries, and US domestic buying is becoming saturated. So who's going to pick up the tab for an extra 150 billion in net demand per month in October? I believe, and I think Lee believes, that the Fed will be forced to revert to QE to keep yields down and finance the ballooning deficit. He calls it...
Yeah, we can't count on China anymore, can we, David?
No, not China. And, you could debate even some of our erstwhile allies like Japan. They were buying last month, but they've been selling prior to that. So you can see that foreign demand for US Treasuries has waned. And this is a nice segue into the next point. So we talked about, global net liquidity, we talked about QT, and now I want to talk about what Luke Groman said on his Macro Voices interview, which was a fantastic interview, and I recommend everybody listen to it, where he talks about the Fed's impossible trilemma. And he credits another Irishman, by the way, Lewis Curran, for coming up with this. Basically, it's this. The Fed has three priorities: low bond yields, and the reason for this is they can't allow bond yields to rise dramatically, as that would sink risk assets, most notably the housing market, which we're already seeing is running into trouble recently, and balloon the debt interest costs and the budget deficit. The bond yield is the risk-free rate for everything, including stocks. So if bond yields take off, the risk is everything collapses in this everything bubble. Second is a higher stock market. I just talked about how stocks are 150% of GDP. The federal tax receipts rely on the capital gains from appreciation in stocks, taxes and IRA distributions, and wealth-driven consumption. They're all key to US finances and ultimately US solvency. So they need a higher stock market. But thirdly, there's the dollar. Now, late last year, the Fed noticed that a weaker dollar pushed bond yields higher. At the same time, Treasury issuance was soaring due to the rapidly rising budget deficit, and the Fed was reducing its balance sheet, again QT, at the same time. So in February this year, the Fed began actively supporting a stronger dollar. However, as we've seen recently, a stronger dollar may help keep bond yields down, but it also has other negative side effects. It's creating enormous stress on the emerging markets that have borrowed heavily in dollars, and risks global contagion, and that could spread to banks globally. Jim Rickards pointed this out recently. There are a lot of derivatives tied to emerging markets, emerging market currencies, bonds, and stocks too. We've seen the effects in Argentina recently, and Turkey already. Contagion in and of itself could cause US and global stock markets to collapse. So another aspect of the strong dollar is imports become cheaper. You increase the trade deficit. We're not seeing it yet because it's a lagged effect. Everybody's looking at the trade deficit falling and saying, Trump's tariff policy is obviously working. It has nothing to do with it. The dollar fell 14% from January 2017 through January 2018. That's a lagged effect. It doesn't happen overnight. It filters through, and that's what you're seeing. Watch what happens later part of this year now with dollar strength. You're going to see that trade deficit go back up again.
Even though it's only been a 50% recovery?
Yeah, you're going to see it go back up again because twofold. It's been a 50% recovery, but it's going up, number one. And number two, you've got these tariffs on top of it. Okay. So that's slowing down global trade. So
bye-bye tax cuts and any benefit from that.
I'm sorry?
Bye-bye benefit from the tax cuts.
Yeah, I was going to get into that. That's another headwind for stocks coming into the end of the year. The only people would ask, well, if QT is or QE is global net liquidity is turning negative and we got those QT happening, why are stocks still going up? Well, you still have net positive global liquidity, and you have a lot of record stock buybacks. And that's been driven by Trump's tax cuts. A lot of money's come back to US corporations. They've not been told to do anything with it, like create jobs. They're plowing it all into buybacks. And that's what's keeping the stock market afloat and pushing it higher. So stronger dollar, the last point on the stronger dollar, it also weighs on the dollar value of foreign earnings from US multinationals. I mean, if the dollar is going up and you've got business in Europe or India, China, wherever, the dollar value of those foreign earnings drops. And that's not good for the stock market, especially if it's the big boys that are driving the bulk of the gains on the S&P and the NASDAQ.
So are you looking for a continuation move to the upside in the dollar, David? We've stalled around 95.5 3 times. You're looking for us to penetrate that and the dollar to make new recovery highs here?
I think the dollar, you could still see some further downside. The previous guys on, I agree with their view with regard to the euro 118.50, potentially up to 120. Those are huge resistance. Oh, that was you, Dale. Okay, sorry,
Yeah,
Gabe.
that guy. Yeah, that's all right. So you think so that would do you think that if we got that break in the dollar, that would most likely, I would think, extend and be supportive of the stock market a bit longer?
Yeah, that's my point, that in the short term we go to all-time highs. I mean, even with the Facebook and Netflix, I still see us getting to October new all-time highs on the S&P. I could be wrong on this one. I'm not tied to it, but a slightly weaker dollar would certainly help with that. But to your question, I think if we do get a crash, just like in 08 and in previous crashes, the dollar is going to see a benefit initially. The dollar is going to go up, and it's a safe haven currency. And it'll go to higher highs yet. It hasn't peaked, but I think it can go down a little further for now, help the stock market, and then when the crash occurs, it pops. But that's the blow off top. Once the Fed reverses course following the stock market crash, which I fully expect them to do, as you saw from the previous slide I put up, the Adler also expects when they return to QE. That's the dollar's toast at that point. And I know a lot. I have friendly disagreements with people on Twitter about this. There are a lot of people out there that believe that the dollar is going to 105, 110, 120. It could. Anything's possible, but I seriously doubt it. Because if you think about it, what's been driving dollar strength has been divergent monetary policies. You've got the Fed executing QT, or the balance sheet reduction, and raising rates, while the rest of the world is still undergoing QE. Draghi's the most dovish ECB or central banker in history, apparently, and you've got China easing now as well. Now they are slowly tightening, but it's nothing compared to what the Fed's doing. If the Fed suddenly flips overnight, that support for the dollar is gone. And that's my view on the dollar.
Okay, so let me, dollar's pretty linked to what's been happening in precious metals, David. So last time you were on, you showed a picture of Putin and Trump and Xi, and you said these are the three guys that make me like gold. So we've continued the decline. You know, we recently got as low as 1210. Is it possible that gold doesn't bottom until the Fed reverses course from in October and begins to ease again until the dollar peak? And how do you handle accumulating during a market that's in a decline when you have a macro bullish view, but on perhaps a shorter intermediate term view that instrument is under pressure?
Well, first of all, I'll deal with the latter one first. I got a question yesterday about miners, given what my views are on the stock market and with respect to gold. What do I do? And my answer is this: have a position, but don't load up. So if you're wrong and it just goes straight up, then you've got a position and you can just add on strength. If you're right and it does go down, gold and miners even more so, then you have the opportunity to load up at lower prices. So the way I would say it is, the answer I gave on miners yesterday was I hold a 30% position of my target allocation, and I expect miners to go lower, but I could be wrong, so I'm hedging my bets by buying 30%. But if it does go lower, and significantly lower, I'll be able to add 70% when it gets down there. So that's the way I would do it. You know, it's not black or white.
It's not easy.
It's unfortunately nothing is with all these billionaires.
Right. Okay. And the miners recently have been acting a little better than the bullion. For the last 6 months, when gold was 1360, you could have looked at any mining index, GDS, any of them, they weren't close to those highs. So they were telling me gold wasn't ready yet. So that's going to be an important thing to keep an eye on. You want to see the miners lead it, don't you?
Well, I'd be happy at this point to see the miners, silver or gold. But I'll say this with regard to the miners. Yeah, I've heard that argument, but if you look back at the chart of miners relative to gold and silver, look at it, the miners have basically gone sideways for quite some time. So they didn't really follow
Right.
the recent pops in gold and silver either.
That's
And
what I mean.
yeah, and they're not following on the way down, so they're kind of like zombies right now, just trying to figure out which way to turn. And so any one of them could lead out, Dale. They have passed the parcel in previous times. Gold has led before silver, miners. With a stock market crash, though, miners are stocks, and I expect them to get, I use the term, annihilated when this crash comes. Now, typically gold and silver do well in crashes, despite what people think. 2008 was an aberration because they were hammered lower by bullion banks, and Dimitri Speck does some great work on this, and you can read his book, but he provides a graph in there which shows clearly that they were hammered lower to protect the dollar and the fiat currency system at the time.
I see.
But that doesn't mean they can't do it again in the next crash. And miners will suffer like every other stock when this stock market crash, perhaps
That's a great
to a lesser
point.
extent.
Most people don't really get that. That's an excellent point, that they may not be immune during the initial phases of the crash.
Exactly, but when you get any whiff of Fed reversal, like we did when in March 2009, with regard to QE1 and QE2, miners are going to outperform. They outperform gold and silver on the downside. Silver outperforms gold too, but on the upside, they vastly outperform gold and silver also. So the idea being that if they do get hammered with a stock market crash, you better have your dry powder ready. Yes, because those things are going to just take off once the Fed reverses course. And you just have to take out a chart and look at gold and silver and miners when the Fed executed QE1 and QE2, and you have your answer. So,
any view on oil, David? We've had two highs recently that have both corrected sharply. How does oil play into your scenario?
Well, I was hoping for, this is a term I would use, a peak around $80, but it may have already peaked. But the point is, I agree that it looks like it needs to go test support a little further, 66 or 65, and then it'll go higher again. The question is it going to go to a higher high or a lower high? Personally, I'm still looking for a higher high around $80, and based on Fibonacci levels for the entire drop from 147 down to 26. And
what is that, 61.8 back?
Yeah, 61.8%. Yeah.
Okay.
And there's another one from its more recent peak at, I believe it's 107. I'd have to dust off my memory on that one, but it's a 76.4 and a 61.8% retracement level. So anywhere between 76.50 and 81. Now, I expect, like, the way oil performs, looking back over the past 20, 30 years, is it tends to go up steadily and then it gets absolutely hosed. And if you think that, just look at the chart. 2000 to 2001, it dropped 54%. 2007, 2008, it dropped 77%. And 2014, I believe it was, I haven't got the figures in front of me, it dropped to around 70% again. So it goes up steadily and then it gets hammered. But if you look at each of those periods, especially 2000 and 2008, they were tied to stock market crashes. And so oil tends to follow stocks down. So to the extent that we have a stock market crash, oil is going to get hammered again. And that's what I think we're heading up into, to answer your question, a peak in oil, and then it goes lower. And it's no coincidence that Aramco pulled their IPO, given what I anticipate is going to come in terms of stocks and potentially the oil market as well. I mean, you're not going to issue or do an IPO when oil's getting hammered. You want to, see renewed confidence in the oil market to get the best bang for your buck if you're selling 5%.
Yeah, you would think that they would put it on the IPO it today with prices here or at 80.
Yeah, I think.
Get there.
Yeah, but if you think about it this way, if the Fed does reverse course and global central banks reverse course post this crash in November or December, whenever that is, or maybe Q1, risk assets, we're jumping ahead in the presentation here, but risk assets are going to explode higher.
You'll be able to buy the world. So short the world into October and buy the world when the Fed flips, commodities included.
And I make this point yesterday with regard to the dollar on sentiment, from a sentiment perspective. You were talking about it earlier. The dollar fell slightly yesterday from a sentiment perspective to 79 at the DSI. It's been as high as 96 recently. And everything else, literally everything else went up, except for, I think, cocoa and a couple of other items that were flat. But the only asset that was down yesterday was the dollar. Now, what does that tell you? It tells you that when the dollar flips and goes south, everything else is going to skyrocket. Commodities, bonds, stocks, the precious metals, you name it.
It's the, I call it the linchpin, the fulcrum of the wheel.
Exactly. Which goes back to this, the impossible trilemma that Luke Roman, Lewis Curran, and myself have been talking about, is that Fed is trying to have its cake and eat it here. They want to have low bond yields, a higher stock market, and a strong dollar. Well, no, you can't, because the strong dollar is putting pressure on the stock market, and based on possible contagion from emerging markets, and also it's going to impact earnings for multinationals, etc. And you're seeing that stress from the dollar, but also from QT on the stock market. Now, Powell said in response to questions about a couple of months ago, when he asked about the dollar's effect on emerging markets, his response, and I'm paraphrasing, was more or less, they're on their own. They can, with respect to the dollar strength and its impacts, emerging markets are on their own. But the takeaway from that was that Powell is likely to continue to tighten Fed policies until something breaks, and that is likely to be the stock market, because there's pressure coming from both ends, from QT and the dollar on the stock market. And once my point is, once the stock market falls, the Fed reverts to QE. They're using the strong dollar to prop up the bonds and keep bond yields down. Once they revert to QE post the stock market crash, they don't need the dollar anymore to do that. They can simply buy the debt through QE. So they can keep bond yields low. They can do what they did since 2009, push stock market higher through stimulus. So that the dollar can be sacrificed in the process, because that will enable them to push inflation higher. It will also improve multinational earnings, yada, yada, yada. So if it's a choice between, if you've got 2 out of 3 you can choose from the Fed's perspective, they're going to choose number 1 and number 2. And it's the dollar that's going to be sacrificed at the end of the day.
That's been the track record.
Yes. Now this is where I use this, what I call holistic approach, or as they say in investment circles, the mosaic theory. Take disparate pieces of data and put them together, and you start to get a picture like pieces of a puzzle. Another one here is, go back and look at Fed speeches from various members of the Fed, or all of them, over the past 3 months. I don't read through every one, but I do look at several reports on what they've said. And it became very clear to me that there was a concerted effort on the part of the Fed to blame Trump for any potential crisis in the near future. And I had 2 takeaways from that. Why are they trying to blame Trump? Because they want to divert blame away from themselves, as per usual. But why did they need to say this, and why are they all saying it? Well, obviously they think something bad is about to happen, and they don't want to be the one blamed for it. And
so does he.
He doesn't either, as he's
he thinks something bad's going to happen. It's the first time he's talked about he's a lower interest rate guy. Yeah, but he's going to let Powell do it. So he's setting up the fall guy too. So what you're saying is there's a war. I didn't know the Fed was doing what you're saying it was doing already, blaming Trump for potentially what could happen to the markets. But this was the first time Trump came out and said he didn't like what the Fed was doing.
Coach.
Yeah.
David. Hi,
Yep.
Steve. sorry to interrupt, and it's very unusual that I interrupt, but I find your interview very interesting. You talked about something that I've talked in the past. You said that they're about to blame him, but I was also talking the other day, and they said the following, and I want your opinion on that. He's making it extremely easy, because candidate Trump was explaining constantly to the people why the economy is flawed, and just a year after he took power, he's trying to explain to people why his economy is doing magnificently, and it's the best economy the US has had in decades. So now he has painted the target on himself, and he will take the fall for things that are indeed not his doing, right?
Absolutely, and I don't want to put on a tinfoil hat here, but I agree with you completely, Steve. The question is, I don't think Trump is stupid by any stretch of the imagination. A lot of people say that about the Fed too. What they're doing is they just don't know what they're doing. That's the easy way out. The more
they know what they're doing.
They know, absolutely know exactly what they're doing. And the idea that these guys are, morons or something is just preposterous. It's just, you don't want to believe the boogeyman's in the closet. The Trump is, as Steve pointed out, if you're a globalist, he's performing perfectly. He's doing exactly what they want. Why? Because he's doing everything anti-globalist. Everything. And when it causes a crash and an economic recession and the GOP to probably be wiped out at the midterm elections, they can point the finger at Trump and see, look, there you are, you populists vote for this nationalist and this Make America, and look what he's done. When you don't blame the last guy to the party for the mess that follows. He just walked in the door. It's Fed policies that have caused it, central bank policies. But he is playing his part perfectly.
Herbert Hoover agrees with that.
Yes. Now, whether it's by design or it's just, he's clueless, you make up your own mind. But personally, I think it's by design. And that's why I say this is all theater. The Fed wants to be able to blame Trump, because A, they always blame somebody else. B, when they revert to QE, they want the people still have confidence in them. I mean, it won't last, but at least in the short term, when they revert to QE policies again, they want to be able to point the finger at Trump and say, look, he's the problem. Because if they were the problem and then they go back to QE, nobody's going to buy it. Everybody's just going to go, oh, here these guys go again. They're just making matters worse. But they have been blamed, and so I agree with your point, Steve. If you look at what the Fed speakers have said, they're blaming Trump's trade policies for all the problems that's been caused around the world. Yet, I think I have a chart here on this. This is the S&P. What happens every month end? It's called QT. That's the Fed. That's the Fed reducing its balance sheet. Look what happens to the stock market every time it comes into month end. It goes down. Not the trade war. It's the Fed. And yet the mainstream media, it keeps trying to, say, oh, Trump's trade war, it's ruining the stock market, it's ruining the world. It's not. It's central bank policies. And then you've got, foreign policy. They talked about North Korea and Iran and the potential risk associated with that. Fiscal, this is a great one. This is spending money to support the economy today, but that means we have no bullets left in the gun for if a recession hits in the future. So he's taking away our dry powder now, which is probably not a good idea, and therefore they can point the finger at him again, like, oops, we're in a crisis now, and you've already spent all of our, any ammunition that we could have used on the fiscal front. Immigration, low-cost labor. That's one of the reasons wages are going up. Come on. I mean, he's only started doing this in the past year or two, so wages will suddenly start going up because, less Mexicans are coming across the border. I mean, and then regulatory, Brainerd's be able to say, I voted against this. Fed's Quarles, the new member Fed Quarles idea to take away some of the Dodd-Frank laws with regard to proprietary trading on the part of the banks. They're in the process of being diluted. That was a 2-to-1 vote at a Fed committee, and Brainerd was the dissenting vote. She said we should keep them in place. Well, then they can pry to Trump, oh, you deregulated the banks again, and look what happened in the space of 6 months.
Yeah.
My point is they're trying to hit him on every single front, and they're not just doing it
It's
once.
all set up.
They're doing it repeatedly. This is coming on repeatedly. So that's another sign to me that not only do they want to blame Trump, but that there is a crash coming. Why would you go through to all this effort to say all of these things across all of these points unless you expect a crash ahead and you want to be ready to be able to point the finger? And then, you know, we've got this trade war. That's what I call mainstream media supported pure theater for what's really happening in the world economy and world markets today. It's the central bank policies that are driving everything. And, you know, I think this chart illustrates it fairly
the trade
clearly.
war is a sideshow.
It's a sideshow. I mean, yes, it will have, if all of those tariffs are implemented, it would have longer term impacts. But in the short term, it's having very little impact. It's central bank policies that have a more immediate impact on what's happening in the world.
Does this analog remind you of 37 when the Fed was tightening after we were coming out of the depression of the early 30s?
Yes, it does.
Some similarities here.
Yeah, absolutely. There's a quote, and I might have it here later, that in the past 100 years, every time the Fed has raised interest rates, we've had a recession follow soon after. And you know, hopefully I have it here, but the point being, you're absolutely correct. They're tightening into recession, and that's what you bring up another point. All this stuff about strong growth, and they're shooting themselves in the foot to some degree, but they keep saying it anyway. Powell came out and said, you know, we're going to continue our policies, gradual rates and balance sheet reduction, and we can because we're seeing inflation, green shoots of inflation and robust international growth. Well, he said this back in May. Well, you know, now we've seen what's happened around the world with Argentina, Turkey, Brazil, Europe. The zoo survey in Europe has been horrible recently. And so that's been shown to be hogwash. I mean, it's pure propaganda. If you look at the micro data in the US, and I say this on Twitter a lot, you look at credit card receivables, you look at auto loan defaults, you look at mortgage rates, mortgage delinquencies. These are soaring. The consumer is spent, and yet when you look at the GDP numbers and the retails, everything's rosy. Well, first of all, the GDP deflator that's been used in the GDP number is incorrect, let's put it that way. And the retail sales number just reflects inflation. It doesn't mean actual purchases have gone up. And I could go through all of that, and don't get me started on the unemployment numbers. When you got 100 million people employed, it just...
David, just a few years ago, like 20 years ago, the unemployment rate was counted with what we have now as a U6. Right.
Yes.
So U6 is currently at 7.8, and like roughly 20 years or a little bit more ago, that would have been the main number, right? And now we've just started ignoring people that are part-time workers, people that have been out of the workforce for 1 year. So obviously that's skewed as well. And about the deflator, I've been saying the same thing. I mean, is there really somebody that believes that the CPI we're seeing is the actual one? I mean, you just have to live in the real world to see that. And even if we take that into account, the CPI has hit 2.9%.
Yes.
Right. 2. And PPI is 3.4. So it actually shows that CPI, you know, has an upward momentum.
Absolutely, and I agree completely. Again, you know, they changed the measurement for the CPI back in the 80s. To show a lower CPI number and use these hedonic adjustments and so forth, which are completely preposterous. They're an arbitrary method of measuring inflation, which basically means they can make it up as they go along. And the obvious reason is that you can have 10% inflation, which John Williams at Shadow Stats shows that the current inflation rate is closer to those numbers on an annual basis than the published ones. Why? Because you can devalue the debt, you know, 8 to 10% on the dollar, that is, over time, which makes it more manageable in real terms. At the same time, you don't have to pay people more Social Security because the official rate is only 2%. So it's robbing from Peter to pay Paul, Peter being the public, Paul is the government. So I completely agree. But going back to the main point, which was the numbers that were being told about the economy are silly, and a great chart you should look at is federal tax receipts. Now people will say, well, tax revenues were cut this year, that's the reason why they're going down. Well, they weren't cut in 2017 and 2016 and late 2015. And if you look at a federal tax receipts chart, they've been negative, in and out of negative since then. So we've been in and out of recession for the past 3 years. You know, those are the cash flows, you know, that you look at for a company. Those are the cash flows for the economy. And they show that the economy is in recession. So when I hear all this stuff about growth and we're about to get GDP numbers tomorrow, and it's going to be 4%, it just makes me smile, and it's silly stuff. I also go back to the reasons why I expect a crash this year. The commercials and the bonds, the smart money, the so-called smart money, they're near record long U.S. Treasuries. Now, if the economy is doing so well, and you know,
they're looking for lower yields.
Absolutely, they're looking for lower yields. And Lee Adler's talking about all this increase in supply from massive budget deficits, and then the drop in demand due to QT starting in October of 50 billion, or a run rate of 600 billion a year. Why do the smart money think yields are going to go down?
Risk.
What could cause bond yields to drop? Exactly. These guys are set up perfectly, and of course the hedge funds or the large speculators on the other side are completely wrongly positioned.
That's the most embraced narrative in the market. I've talked about that in several interviews. The one narrative everyone accepts is the bonds are in a bear market.
No, well, they are in a bear market, but that bear market, they're in a secular bear, or I would say a very brief bear. But no, the Fed cannot. Going back to the trilemma that Luke Rowan brought up, the Fed can't allow bond yields to soar. That's the end of everything. If bond yields were to go to 4% or north, you blow up the budget deficit, you blow up every derivative tied to the 10-year risk rate, you blow up the housing market. I mean, I could just go on and on. Everything falls apart. It's critical. And they've been relying on, money market funds in the US, which they forced to buy these US treasuries. They're forcing the banks to buy, the commercial banks, the big banks, to buy these treasuries. At some point in the future, they're going to saturate that demand, and they're going to have to, go back to QE. And that's another reason why, they would want to crash, so that they can do that. So they can revert to QE, buy the debt, monetize it, and keep bond yields down, because the bond yields are okay.
David, what do you think will happen to cryptocurrencies during this type of scenario you're predicting in October?
I think, Chris, cryptocurrencies are looking, like I said on Twitter there recently, that they're going to go through another round of euphoric demand here, in my opinion. Tinfoil hat, it's to help divert demand away from gold, which is also about to take off. And I think they will perform extremely. They won't do too well just beforehand, but and when the crash is underway, just like gold and silver. But once the Fed reverses policy, they'll take off. But I don't think the authorities, the establishment, is going to allow cryptos to persist much longer. The whole purpose of cryptos, in my opinion, and I know I'm going to get trashed for this on Twitter, is to promote digital currencies, and
so that the government could have their own.
Absolutely. The Fed coin has already been prepared. Putin's talking about the ruble, the crypto ruble, etc. And then ultimately you're going to get a digital SDR. So that's where I think that's what I think is going to happen to crypto.
So they let the experiment go on for the general public to embrace it, so it won't be a radical thing for people to accept it coming from the government, and let all of these thefts that happen online, they could sell it as a secure digital currency.
Yeah, yes, and the establishment will not allow anything to compete with them. Now, could crypto succeed based on popular demand? Possibly, but the establishment is going to do everything in their power to limit any competition to their digital currencies. Put a different way, banks are not going to allow individuals to create shadow banks to take their business away, and the bankers rule the world. So the bankers are going to use every method to shut down cryptos once they start rolling out their digital currencies, in my opinion. Okay. Whether they succeed or not, that's another question, but that's what they plan to do.
Because it certainly is easier to carry around a little, I don't even know what a wallet looks like, David. I asked someone I interviewed about crypto if for baby boomers like me, they could make their wallets leather bound. But they're definitely portable, right? I mean, you could just have a little computer thing you put in your pocket with all your wealth and go anywhere.
Yeah, you can use a flash drive.
Yeah, that's what it is. Flash drive.
You just, you know.
That's a pretty. That's even an advantage over physical gold and silver, isn't it? I mean, try and transport metals across borders.
Yeah, but for me, I have no issue with that, to be honest.
Yeah, because you're already dug in.
Yeah, but I mean,
you're not going anywhere.
Yeah, but transporting it across borders is not an issue for me, to be honest. Just transferring it from one depository to another, or foreign exchange deal. You sell your gold here and you buy it somewhere else, just like you would sell your Canadian here and you buy your US dollars there. Okay. I find that argument, it's valid to some degree. It's not as instantaneous or not as easy as it is with cryptos.
Right.
But the bigger issue is the store of value. What's portability relative to store of value? Bitcoin soared last year, got crushed as I anticipated in December once the futures markets came around, and now it's getting signs of life again, and we're going to go up again, and then it gets crushed again. Some would say, well, it's the same thing with gold. No, not to the same extent. It's far less volatile than Bitcoin. I mean, you had graphs of tulips back in December. Gold has never done that. So
yeah, they've approved senior citizens can hold precious metals compared to crypto because the volatility is so low. So yeah. ARP has approved it, American Association of Retirement.
Oh, okay. Also, guys, gold is never going back to zero simply because it has physical attributes that will always, help it retain some value no matter what. I mean, there are several things that you can do with gold that humanity has been doing with gold in the ancient times and today as well. So there is no question gold does have intrinsic value. But David, if I may, I wanted to ask you one question. What are the chances? You talked a little bit about a potential end game. And in my opinion, a potential end game, which is what? Getting again what we got in the 70s, which is stagflation, yes. Are much higher than the market thinks. So, for example, the chances of actually getting some runaway inflation at the same time that the economy is going to be tanking, I think that, the markets don't even take it into account. I mean, they do think that during the next recession, whenever that happens, we're going to have the same story repeating itself, like bonds, treasury bonds, etc., getting paid, so yields going down, and the economy obviously suffering, and employment going up, and at some point, stabilizing through monetary policy, and rinse and repeat. What if this time, especially given the dire situation with deficits, debt, etc., the market loses its faith in the treasuries, loses its faith in the dollar, and we get stagflation? What then? First of all, do you think this is a possibility?
Not only a possibility, that's my view on what's going to happen in 2020, 2021 timeframe. We're going to get this, that's exactly my outlook. That's why I'm holding gold and silver, and I expect it to go multiples higher. QE does absolutely nothing for the economy or Main Street. Nothing. It's like you just have to look at real wages since 1989. The consumer is tapped out. So when they roll out QE again to basically boost the economy again, they'll boost assets maybe, but they're going to realize that they can't fool everybody any further. So you're already starting to see helicopter money. I mean, the subsidies to the farmers due to the tariffs, I call that the first instance of helicopter money. We're talking about universal income benefits, which is another ridiculous idea, right up there alongside negative interest rates. Negative interest rates pay somebody to borrow money from you, and universal income benefit, we're going to pay you for doing nothing. So they're going to roll out these programs after the crash and the crash will be the excuse to do so. And the idea would be that they need to keep the engine of consumption going. So they're going to flood the economy for the first time with liquidity. Well, the number of goods produced isn't going to go up dramatically overnight. And I like to look things in simple terms because then it's easy to understand. But if you've got more dollars and euros and yuan and yen chasing the same amount of goods, what do you get? You get inflation, or as Steve just said, stagflation. And that's exactly what I expect. That's what I anticipate. We talked earlier about Aramco and pulling their IPO and what QE will do for that. Oil's going to soar to triple digits. Gold's going to soar. The can of Coke is going to soar. That's my anticipation, that you're going to run into an issue of stagflation. And the culmination of these events will be the end of the dollar as global reserve currency, a switch to probably the SDR, supranational currency, and a debt jubilee across the world, in the US, Japan, etc. And that'll be the global monetary reset. But prior to that occurrence, you're going to get stagflation. And then when they do that global monetary reset, they're going to have to do it in order for it to work, unlike what the UK did with the gold standard in post-World War I. You're going to have to do it at a value that is somewhat inflationary on top of all the inflation already underway in order for it to succeed. And that scenario, then gold, silver, they all just explode. Commodities explode, and this is all supports the whole view in commodities. Look at what commodities have done, like coffee, cocoa, sugar, live cattle, soybeans, cotton, you name it, wheat. They've all been absolutely hosed recently, and because they're about to go into a major bull market here in the next 20 years. They're going to absolutely explode higher because currencies are going to be debased on steroids. And that goes to your point, Steve, with regard to stagflation. It's going to be like the 70s, but even more so because the amount of energy that's being built up with all of the central bank printing on top of what's going to come, Dale, I shared with you in February, I expect monetary insanity on steroids. It's not going to be just QE. It's going to be NERP. It's going to be asset seizures. It's going to be wealth taxes. It's going to be physical cash ban. It's going to be the whole kit and caboodle next time around. On top of what's already happened.
Compare the state of the economy in the 70s, which had the potential of rebounding, easier, with the current state of the economies. I mean, back in the 70s, the US was still probably the biggest creditor nation on the planet, and it's currently #1 debtor nation on the planet, right? So obviously not if there was a worse period for that to happen, obviously it's now, not back then.
And they made stuff back then. Now it's a paper economy. It's being fully financialized, more or less, which Absolutely. Trump's trying to reverse, but he's trying to reverse too quickly. That's the problem. And the other thing is that the debt numbers, going to, one of the issues with regard to Luke Roman's comment on the trilemma was that, could they, if inflation takes off, by going back to QE, can they just jack up rates? No, they can't, like they did back in the 80s to deal with the weakening of the dollar. Couldn't they do that? No, they can't, because the debt is far, far, far greater today than it was in the 70s, to your point, Steve. And the US economy is a shadow of itself back in the 70s, and more so back in the 50s and 40s post-World War II. So yes, it's a very different situation that we have today, and absolutely I expect stagflation. But let's get back to just to finish on the points on why I expect a crash. The copper curve, not many people watch this anymore, but it predicted the 2000 crash, it predicted the 2008 crash, and it's telling you something right now with regard to the current state of the market as well. Just I reference that because not many people watch it, and it's raising alarm bells too. And by the way, it's not just 2000. And
much longer, much longer than
you go back to this past century and look at it and see it. Dale, you and I said at the end of the last interview about goals, follow the smart money. Well, the same thing with regard to the stock market. The elites like to tell you in advance what's coming, the IMF, etc., so they can say, I told you so after the fact. They don't hide the fact of, with regard to what's coming. Jamie Dimon basically warned of a panic in May. That panic was coming due to QT. He's done it 3 times now. He came out again there recently and said so. Dalio is short on all financial assets for 2019. He may be conservative in 2019. I expected sooner, but the fact is he's short. And Buffett has the highest amount of cash on hand ever. It's the sad part about Warren Buffett is he's a fantastic investor over many years. But unfortunately, I feel like he's a cheerleader for the establishment now, because he says one thing and he does another. He's saying the economy is great, stocks are great value, and yet he's got the highest amount of cash on hand in his portfolio ever. What's he waiting for? I think he's going to go bargain hunting here in the next few months. That's what he's waiting for.
Well, he says that so he could offload his shares. He needs buyers.
Well, I'll let you say that, Dale.
Okay,
I'm already going to get blacked on the cryptos.
Okay, all right. I think they all do that, buddy.
Yeah, no, I agree. But
okay.
I'm going to get some.
The Crash Club. Where do we get our sweaters?
I put this thing in the Crash Club because when I made these statements back in February, I was one of the few, and now I see a lot of names coming on board. And I just threw this up there so that you can see it's not consensus by any stretch of the imagination. I hear this a lot. A lot of people think this, but as Steve pointed out with regard to stagflation, a lot of people think it, but few people, it isn't in the mainstream yet. There's a lot of people who are thinking about this stuff, but it's increasing, but it's still a very tiny minority relative to the broader market. The answer, the counterpoint to that, oh, well, this is becoming, because everybody thinks this, then why is the stock market going up? If everybody was thinking that we're going to get a crash tomorrow, why is the stock market going up?
Right.
Last fool theory, I'll be out before anyone else, maybe. So there's a number of quotes there. Enjoy afterwards. I like this last one from Macquarie. Fed will halt its balance sheet reduction in 3 to 6 months. He captures it perfectly, which ultimately leads to, and this is my view, a world of pervasive negative interest rates, QE, and CBs do everything in their power to prevent the zombie system from collapsing. I mean, I couldn't put it better myself. That was really well said, and that's fully what I expect. And that goes to the whole stagflationary discussion we just had. The Fed itself has given you a heads up on multiple occasions that this is going to happen. Powell says upon nomination, this is the strangest comment to say when you're just taking over the Fed, when everything's supposed to be wonderful, Goldilocks. We must be prepared to respond decisively and with appropriate force to new and unexpected threats to our nation's financial stability and economic prosperity. I thought everything was wonderful. Why are you buying insurance all of a sudden? And then you've got Yellen before she, was told she was not getting the job anymore. Yeah. Fed may have to turn to QE in another downturn, absolutely. And then even Williams, who's now the New York Fed head, he said he was talking negative interest rates in the USA in 2017. So they're already giving you a heads up for what's coming. And, all of the data that I'm seeing suggests so too. The last thing I wanted to say was signals that I'm watching with regard to when the stock market crash is about to occur. I already mentioned negative divergence on the S&P on the monthly chart. Again, you can look at the weekly and daily for an earlier warning. Widening credit spreads. If you see widening high yield or investment grade credit spreads, credit leads equities. Equities are the dumb money. Credit is the smart money. High yield peaked in June 2007 before it absolutely dumped, and equities peaked in October. So high yield gave you a heads up in advance. And you've got falling treasury yields. Treasury yields peaked in July of 2007 and were falling before the equity markets got the memo. Then you have the yield curve. Everybody focuses on the negative yield curve. Actually, what the concern would be the hockey stick. When you see the yield curve hit a bottom and start to go back up, the 2-10-year yield curve, that's when you need to be worried. In March 2000, and when was it here? In, I think it's around June, November 2006, it bottomed then as well. And then the yield curve started to rise. That
Isn't
was
that
the
interesting?
signal.
Most people are worried about it, the yield curve going negative.
Yeah, and why is it going up and going into a crash? Because as I just said, yields were falling. They peaked.
It did that in 87 too, David, with your analog. Rates were going up dramatically.
Yeah. So
the bond market peaked in April of 87. I'm a historian.
very good.
All right.
So the yields fell. The yields fell, started to fall in 2007 to 2008 ahead of stocks.
Right.
And then you had the yield curve start to go up.
Great point.
How is that possible? Well, short-term yields dumped. They fell faster than long-term yields. That's why the yield curve was steepening. That's the hockey stick. And here we are here. And you don't see it on this chart because this is a monthly chart, but we actually get down to 24 basis points, and we could go lower yet.
Yeah.
But when you see this, it started to creep up again recently. If you start seeing this hockey stick and those other indicators as well, that's a major signal that trouble is brewing for stocks. And then, of course, there's the VIX.
Yeah.
Watch the VIX. It got down to, in January 2007 to a low, and it started to set higher lows from that point. And then you're starting to see the same thing here.
Still have a higher low, but it's almost at new highs in the market.
Sorry?
We still have higher lows in VIX with the market almost at new highs.
Yes,
so
exactly.
I don't think we're going to see 951 even if we get new highs. Do you, David?
No, along with the other signals, I'm planning to. I've already added some QQQ puts. Thank you, Facebook. But I'm layering in once this starts to get around 11. I'm going to layer in. We may get down to a 10 handle, but you're not going to get down here again, in my opinion.
Yeah. Okay.
And then you've got dollar yen. Dollar yen peaked in when was it? June 2007, and then boom, the yen, which is a safe haven currency, which is the most preposterous thing on the planet, given what they do with they're giving them much money to print. But that's what happens. Dollar yen collapse. I'm seeing signs of this already, and Steve can talk to this too. If you look at the DSI in the yen, it went down to the teens there recently. It's popped back up to 29. It's in the 20s, but I could see that falling again to a higher low, and then you have a higher price, higher dollar yen, but a higher low in the DSI, and then dollar yen dumps. But the point is, once you start to see this play out, dollar yen falling, that's another signal that trouble's brewing. But one of my main ones, and I do love sentiment, if you look at the DSI going back to 2007, 2008, it peaked in May 2007. The spot was 93, and this is for the S&P. The 21-day moving average was 89. And then you fast forward to October 2007, it went down, you can see this drop here, and then it went back to a peak of 88, which is a negative divergence at a higher high in price, and the same on the 21-day moving average, it was 83. So you had a negative divergence not only on the RSI, the MACDs on the technical chart, the sentiment was telling you there was a negative divergence as well. And then I look at now, in January, we got up to a ridiculously high DSI of 96. Well, all of the numbers were off the chart. The 21-day moving average peak was 88 on the S&P. Well, spot DSI yesterday got to 85. The problem for me is the 21-day moving average still isn't high enough yet for me to feel comfortable that, we've seen a peak. But on top of that, the price hasn't set a new high. For a negative divergence, you need a higher.
Yeah, you need a new high.
Yeah. But this is only a matter of time. This is one of the key ones I'm watching. When I see this 21-day moving average get back towards the high 70s, 80s maybe, that's when, because I don't expect it to get back to this number. I expect it to do what happened here. You're going to get a lower peak at a higher price, a lower peak, a negative divergence. The same thing expect with regard to these guys. I expect this to be a negatively divergent peak, this to be a negatively divergent peak, and this to be negatively divergent. So you put all of those together, plus all of the other indicators, credit, dollar yen, VIX, and you have a few signposts to tell you it's time to get out of Dodge. And here's how, my last slide, pre and post crash strategy. equity puts, I've already got some QQQs, and only a small allocation at this point, more placeholder. But I plan to add more, and for the S&P as well. Facebook didn't do me any favor. They did on my QQQs, but I wanted to add puts in Facebook as well, but they've already shot the bolt, as it were. But to the extent that Amazon has good results, I'll be definitely looking to add puts on Amazon stock going into a crash in October, or if sooner or later than that. As I mentioned, oil falls with the stock market. You could see it if you look at Elliott Wave. You could see oil fall down to 26 again. Yeah, 26 below. Yeah, 15. I don't need it to go that far, but you could see it fall that far. Put simply, I expect everything to dump except the yen, the dollar, and U.S. Treasury bonds. Precious metals, we were talking about gold earlier. There could be one more low there associated with a crash because the bullion banks hammer them lower, and because crashes are deflationary. So all commodities to fall to a lower low. I've been saying on my own site on Twitter that I expect commodities to bounce with stocks into these all-time highs in the S&P, and you're seeing that recently. I posted this yesterday, that you're seeing coffee bounce, you're seeing cotton bounce, you're seeing wheat. They're all starting to have a leg up. That's a false dawn. I think they're going to get hammered again one last time. But then that lower low, just like with gold and silver, you want to like back up the truck for that one. And this goes to my post-crash comment, which is that I expect, and I'm not alone, that the Fed and global central banks will reverse to QE, a monetary stimulus on steroids. If that happens, buy everything. But I prefer precious metals, but stocks are going to go up, precious metals are going to go up, treasuries, thanks to QE, the yields are going to go down, maybe even negative, much like in Europe. Prices go up. Commodities are going to soar, basically everything except the dollar. And
that's how we get an S&P 4200, but gold and miners will way outperform that. And that's how people think things are okay again, because the stock market rallies to new all-time highs.
Exactly, which goes back to my very first, what we talked about in February, is this scenario right here.
Got it.
And this is nominal. So when you tack on the inflation in real terms, you're talking about an 80-90% crash.
Yeah. What a great presentation, and you broke another record. The longest interview I've done in my career.
Oh my God, thanks very much. That's
another record, almost over an hour.
Well, I apologize.
Huh?
I'm grateful. But I apologize as well.
Oh no, it was outstanding, David, and this will be retweeted into infinity, I believe. And there's just one crisis, and I think you're probably prepared for it. And it's not global warming; it's the coming of another ice age. And I know it's cold up there already, but get backup for your pipes, because a lot of these guys that have been talking about a shift are talking about what's happening with the sun, and it's completely the opposite of global warming, especially if a few of these volcanoes go off, that we could have another mini ice age. It's happened before, but you're used to it anyway. You're a polar bear. So I'd like to thank you, David, for sharing, a great presentation that you took some time and thought to prepare, and glad to know you and appreciate your edification and sharing what isn't easy to say, because most people don't want to hear it. So I also appreciate your courage, my trading warrior brother, of laying out the facts as you see them.
Thanks, Dale. I mean, that's my mantra, basically, is doing just that. I apologize earlier because, Irishmen, a few of my colleagues and fellow Irishmen might disagree with me, but we like to talk. So you should actually see me on a few beers. This interview probably would have taken a few hours, but I appreciate you taking the time, is my point, and I appreciate your support. These interviews are a wonderful way to get the message out, and I do appreciate the comments from the interruptions from Steve too, because I like a dialogue as opposed to just me pontificating about what's happening in the world. But another thing about Irishmen gets us into trouble. We speak our minds, we're honest, and I put my money where my mouth is. I believe everything that I'm saying. This is
skin in the game.
Yes, the people I hate most in the world are car salesmen, for that reason. But I believe everything I'm saying, and I thank you for the opportunity in being able to share this message with a lot of people, because unfortunately when these things happen, it's the little guy who gets crushed every single time. So the more people that can be made aware of this risk, the better. And you know, I often get these comments basically that, oh, you prepared too early. It's better to be early than late when it comes to preparation. And you're going to get a crash, and you're going to get another blow off top in the S&P. But dark times are ahead, as you said.
Yeah, but some great, really great, once-in-a-lifetime trading opportunities with these kind of swings that are going to be there for us, besides what it's going to be like on the ground at ground zero. Really phenomenal, life-changing type trading opportunities that are setting up here in the next year or so.
Yeah, and I just want to say quickly on that point, Dale, with regard to gold and silver, you get a lot of people who are getting very concerned about gold and silver now, and the drubbing it's taking, and now we're talking about new lows below 13 I've seen on silver and so forth. Yeah, maybe, but you know, that's just typical sentiment at lows for me. When everybody's looking at gold to 700, 900 and silver to below 13, I start looking in the other direction. And even if it does go that low, trust me, when this all plays out, gold's going to be multiples higher. Silver's, we could be at $500 per ounce in silver. Will you really care if it falls from 16 to 13, if it's once it goes to 100, 200, 300, 400? The Chinese, the Russians, JP Morgan, they're all preparing for this. Just follow the smart money. Put it in a drawer, forget about it. You'll thank me in 3 years, 4 years. It's going to pay off handsomely.
Thank you, David. You're my second favorite Irishman.
Thank you,
Morrison.
David.
Van Morrison being number one.
And I have to take down his mantle.
Okay, buddy.
Thank you.
Everyone, thank David Brady. You can follow him. Go to his website at Pro Global Trader on Twitter, and this has been recorded, so it's going to be there for you guys to check all the way through the end of the year. We'll see how David does. So again, thank you, David. Good hunting. And that's a wrap for us today, everyone. Remember, don't just count your pips, count your blessings. And see everyone to wrap it up with TGIF. Enjoy the lunar eclipse tomorrow, and we'll have Moon Man Norm Linsky with us. Thanks again, David. Adios,
Thanks,
bro.
Dale.
You're
Bye-bye.
very welcome. See you, Warriors. Talk to you tomorrow. Thank you, Steve, for helping me with the interview. See you tomorrow. Adios.